When a company makes a sale, you'd think the accounting would be pretty simple, right? Cash comes in, you book the revenue, easy. But what if I told you a single $1,200 sale wasn't actually a $1,200 sale, at least not on day one? What if parts of it could only be counted as revenue months or maybe even a year later? Well, today, we're going to dive into the fascinating rules of revenue recognition and find out when a sale isn't quite a sale.
So, here's our game plan. We'll kick things off with a quick refresher on the 5-step model that kind of governs everything. Then we'll get into 2 super common but kind of tricky situations: contracts with multiple bundled promises and services delivered over a long period of time. After that, we'll talk about why these rules are so critical for trusting the numbers. And of course, I'll leave you with the key takeaways. And believe me, this isn't just some abstract academic exercise. Financial executives are the first to tell you, getting revenue right is a high-stakes game. It's gotten more complex, it's easier to make mistakes, and it's one of the single most important numbers on the financial statements that investors look at. Okay, let's get into the framework that helps bring some order to all this chaos.
This right here is the universal toolkit. It's what all public companies use to figure out exactly when and how much revenue they should recognize. It's a global standard. You might hear it called IFRS 15 internationally or ASC 606 in the US, but really, you can just think of it as the official rulebook.
The model has 5 really clear steps. First, you identify the contract. Then you figure out all the distinct promises you've made to your customer. We call those performance obligations. Next, you determine the price. You allocate that price across all your different promises, and then, and this is the most important part, you only recognize the revenue as you actually fulfill each of those promises.
And now, all 5 steps are crucial, but where does it really get interesting? Right here in steps 2, 4, and 5. This is where things get tricky, especially when you're dealing with bundled products or long-term subscriptions. And that's exactly where we're going to focus our attention.
All right, let's jump into our first case, the product bundle. Think about your cell phone plan or maybe a new laptop that comes with a bunch of software and support. You make one payment, but the company's actually given you multiple things. So how on earth do they account for that?
So imagine this scenario. You walk into a store and you buy this laptop bundle for a flat price of $1,200. On the surface, it just looks like one single sale. But from an accounting point of view, we've got to look a little deeper. This is where we use step 2 to kind of unbundle that sale into its core promises. In this deal, the company has 3 distinct performance obligations it has to deliver on. It has to give you the physical laptop, it has to perform the service of installing the software, and it has to fulfill that ongoing promise of 1 year of tech support.
So what do we do with that $1,200 price tag? Well, we can't just book it all to the laptop. Step 4 tells us we have to allocate it based on what each piece would sell for on its own. So if they were sold separately, all these items would actually cost $1,300. We just use those proportions to fairly carve up the $1,200 bundle price. So the laptop gets $923, the installation service gets $92, and the tech support gets the last $185.
And that brings us to the final step, step 5, recognizing the revenue. And this is key. Revenue is only booked when an obligation is actually met. So on day 1, the company delivered the laptop and installed the software, so it can recognize that combined $1,015. But the tech support, that's a promise for the next 12 months. So that $185 has to be recognized bit by bit, about $15 every month for a whole year.
And that right there is the big aha moment. Your one-time payment of $1,200 does not equal one single revenue event for the company. Nope. It gets split up and booked over different time periods, perfectly matching when the value is actually delivered to you. Pretty cool, right? Now let's see how this same idea applies to services.
This brings us right into the heart of the subscription economy. It's everywhere today, and yep, it presents another really interesting revenue recognition puzzle for companies to solve.
This is the world we live in, right? We're all super familiar with these. Just think about your Netflix or Spotify account, a gym membership, or that cloud storage you pay for every month. In a lot of these cases, you pay up front for a month or even a year, but the service itself is delivered to you continuously over time.
So let's ask the $1 million or $120 question. A customer pays you $120 for a full year of your streaming service. You've got the cash. It's in your bank account. Can you book all $120 as revenue on day 1? What do you think?
If you said no, you are absolutely right. The answer is a hard no. Recognizing all $120 up front would be just plain wrong because the company hasn't actually earned it yet. It still owes the customer 12 full months of service. The correct way is to recognize just $10 of revenue each month as that month's service is provided.
See how that perfectly matches recognizing revenue with the company's performance?
This brings up a really critical accounting concept. That $120 in cash, it's not revenue yet. It's actually a liability. It gets recorded on the balance sheet in an account called unearned revenue. Now, why a liability? Because it represents a promise, an obligation, to the customer that the company still has to make good on. For software companies especially, this is a key metric investors watch because it's a peek into future revenue that's already in the bag.
And here's how that liability slowly turns into revenue. Each month that goes by, the company fulfills 1/12 of its promise. So it just moves $10 from that unearned revenue liability account over to the revenue account on the income statement. It's a gradual, logical process that shows value being delivered over time.
So we've walked through the mechanics for these cases, but let's just zoom out for a second. Why do we even have these rules in the first place? Why does all of this matter so much?
Well, it really all comes down to integrity and being able to compare companies fairly. Without these rules, companies could so easily mislead investors. Imagine a company booking a huge 5-year contract as revenue all in year 1. Their sales figures would look absolutely incredible, but it would be a complete fantasy because the work hasn't been done yet. These rules prevent that kind of manipulation. They make sure that revenue reflects real economic activity.
At the end of the day, the goal is to create financial statements that investors, lenders, and even managers can actually trust. The 5-step model forces companies to report revenue in a way that truly shows the transfer of goods and services, and that gives everyone a much clearer, much more reliable picture of a company's real financial health.
Okay, let's bring it all home and distill this down to the core principles you really need to remember from our little explainer today. First, anytime you see a product bundle or a contract with multiple parts, you have to break it down. You allocate the total price to each separate promise, and you recognize the revenue for each part only when you've actually delivered on it. And second, for subscriptions or any service that's delivered over time, revenue has to be recognized gradually as you perform that service. Any cash you get up front isn't revenue yet. It's that liability we talked about, unearned revenue, until you've actually earned it.
If you remember just one single thing today, please make it this. The golden rule of modern revenue recognition is that revenue follows the delivery of value, the satisfaction of your promise to the customer, not the simple exchange of cash. If you can keep that one principle in your head, you'll be able to make sense of almost any complex revenue situation you ever come across.